Relative valuation, right? So, in relative valuation, essentially what are we trying to do here? We're trying to use other peers or similar companies to value our company. Right? So that's why we mean relative to another company or another market or the whole market or the industry. Right? Relative to something else, how much am I worth? That's what we try to do through relative valuations. These are also called multiple-based valuations, multiples-based valuations. So here, what we're doing is we're looking at different ratios, right? Like the PE ratio, PBV ratio. It could be price to cash flow ratios, price to sales ratios. And based on these ratios, PE, PBV, price to sales, price to cash flows, price to sales, right? Based on these ratios, we try to come up with how much is my company worth. Now, your company's ratio is not relevant. Your company's ratio is not relevant. What we're trying to do is look at peers. We're looking at your relative valuation. So we're trying to look at other companies that might look like you or the industry or the market, right? And say, okay, if the market is 9.73 times, how much must I be worth? If the industry is 10 times PE, how much must I be worth? Based on my earnings. Why don't we use your earnings, your PE ratio? Because your PE ratio is anyway made up from your earnings, right? So what we do is we essentially take, let's say, if I wanted to find the price based on PE ratio, what would I do? I take the PE ratio and I multiply it by the earnings. And the basis is that this earnings to this earnings will cancel off. And what I'll be left with is the price, right? If I try to do that for my own company, then it's my earnings anyway, and the PE ratio has also been made out of my earnings. Okay. So I can't do that. Therefore, what should I be using? I should be using peers. Peers, right? When I say peers, it's not necessarily, it can be other companies, right? Another company that looks like my company, that does the same businesses, that is in the same business lines, right? Size-wise, something similar. If I use the PE ratio of that company, other people are willing to pay that many times the earnings of that company to buy that company. So then, based on my earnings, how much are they willing to pay me? That's what we're trying to check, right? So if, for example, you have company A who's trying to figure out what is it worth, right? Company A who's trying to figure out what is it worth. And then you have company B who's an established company in the market. Then we can use relative valuation to figure out how much is company B worth. Company A worth. How do we do that? We use company B's PE ratio and then company B's PE ratio and multiply it by company A's earnings. Company A's earnings to come up with company A's share price. Any questions here? And this doesn't have to be just for PE ratios. We can do the same thing for price to book value. So the price of the company today is equals to, you look at the peers, for example, price to book value, and then multiply it by your company's book value to come up with the price. Or if it's price to cash flow, the same thing. How to come up with my price I look at the price to cash flow of the industry or my peer company, and then use my cash flows to come up with the price of my company. Same thing with price to sales. What is the price of my company? I can use the price to sales ratio of the, for example, market multiplied by the sales of my company to come up with how much my company is worth. So I compare it against either other similar companies, I compare it against the industry, or sometimes even the entire market, right? Entire market is generally better if the company represents a large portion of the market, or if, for example, the company does represent in terms of at least the style of the market, right? But otherwise, it's just a lazy way of figuring out how much your company is worth to use the market, because the market and your company, the similarities are very low. But if you take your industry, there might be more similarities. If you take similar companies, there will be very higher similarities, right? So you look for peers, ideally peers. What are my peers' PE ratios, PBV ratios, price to cash flow ratios, or price to sales ratios, depending on the type of industry I'm in. I would then look at those ratios to come up with what is the price that is relevant to be paid for me. If somebody else for a very similar company, let's say, for example, uh, so if we look at new listings, we have commercial banks debenture and we have a new IPO. Smaller company in the Empower Board, Maharaja Foods, coming up with their IPO, right? And if you look at their research report, you see that the research report says equity value based on selected peer price earnings ratios and equity value based on discounted cash flow methods, right? So I'm not talking about how it's done. I'm talking about how it's done versus what has been done. Okay. Yes. Right, P ratio. So P multiple approach was applied using peer-based earnings multiples to gauge the relative value of the share. Right. So here you can see. That's not what I'm looking for. There was something else. Okay. Something like this. Yeah. So this is their expected earnings, right? And CX in listed peers, comparable peers, they've taken a discount to the peers, right? They've taken a discount to say that Because remember, we said when you come in an IPO, you usually give a discount. There is money left on the table to incentivize investors to come and invest with you. So they've taken a discount to the peers that they have identified, and they've used other companies that are similar to them, used those PE ratios, consolidated those PE ratios, and given a 30% discount. So looked at their earnings, multiplied it by the PE ratio to come up with the equity value of the company. Give me 1 second, please. So similarly, depending on the type of industry you're in, you would use either PE ratios or PBV ratios or price to cash flow ratios. That really depends on your industry as well. So, for example, if you're in the banking industry and your new bank is doing an IPO, you generally wouldn't use, if you're using relative valuation, you would find peers that are in the banking industry and you'd use valuation models such as PBV valuations versus PE valuations. Because for bank valuations, what's more relevant is PBV versus PE, right? If you're not making a lot of profits for startup companies, for example, companies in the tech space who need a lot more ramp up time to make profits, then they might use the price to sales ratio, because the price to earnings might be earnings are negative, therefore does not make sense. They're nonsensical, right? So the price to earnings ratio is not applicable, and therefore you can't use it. So these are things that you would consider when you're looking at your multiple based models. The important thing is always you have to look at the future value, earnings, next year's book value, next year's cash flows, next year's sales to figure out the value of your share today. Okay. Any questions? Okay. Try the example. Okay. Yeah, it's it. It's a very easy question. Thank you. 28, correct. So industry PE ratio, industry PE, this is the industry, is 16. What is the current stock price? If the earnings are 1.13 per share, expected earnings, right? Expected earnings are 1.13 per share. So the price is equals to the P ratio of the industry multiplied by your earnings to come up with price into earnings 16 into 1.13. So your company is worth 18.08. Okay. So that's a relative valuation. That is not necessarily the best method of doing a valuation, but it is another method, right? Because why we say it's not the best method of doing evaluation is because you don't know if those companies, those peers that you're choosing are really relevant. You have to analyze whether they are actually in the same industry. Within an industry also, when you take like these Ps for industry, you have to analyze like, are there any extreme examples that we have to take out, right? But it's an easy one. It's an easy way to do a very quick calculation to see whether these companies in line with the industry, or do I have to pay a premium for it? And if I have to pay a premium for it, is that premium justified? It's a quick way for me to figure out. Okay. That's why we do relative valuations. That's just to rank ourselves with our peers, right? And to figure out, okay, if there are premiums being paid, if the discounted cash flow is saying this valuation should be higher, and if that is the way that the IPO is coming out, for example, is there a rationale for that? Is it that the discounted cash flow valuations are wrong? Or is there a rationale that I just command a better premium, that my company commands a better premium than the other companies in the market, or this company commands a better premium than the other companies in the market, right? That's another way of thinking about it. So it's a very easy way to do it because industry Ps are available, market Ps are available. You can calculate peer company PEs, right? If peers are not available, you can go to the region. Look at regionally what are the companies that are there that emulate what you do. And based on that, you can figure out what is the price, what should be a fair price to pay for this company. So because of the ease, these multiples-based ratios or relative valuation ratios are very popular as a method to figure out whether to buy or sell a company, whether the company is overvalued or undervalued. It's a very popular way of figuring it out, right? Not necessarily very accurate, but it does give anchoring to your valuations, because your valuations, remember, in valuations we say, and especially when we come next now to the free cash flow valuations, we always say garbage in, garbage out, right? There's so many assumptions that go into our valuations. If our assumptions are wrong, then the final output, the answer is wrong. Relative valuations give us a way to anchor our valuations, to figure out are our valuations on the right track. These other companies people are valuing at these levels. Can we justify it or not? Okay. So it's a way that we can use to figure out whether our valuations are on the right track, to anchor ourselves. Okay. And for retail investors, it's a very easy way to carry out a quick and dirty valuation, back of the envelope type valuation, to figure out if this company is overvalued, undervalued. Does it rank? How does it rank with peers? Any questions here? So in between, I've just put in the equation for justified PBV also, right? Just like justified PE. So this is the actual market, PEs and price to books and all that, right? Justified PBV is based on your intrinsic values. Remember, just like we came up with the model for justified PE, to be 1 minus B divided by R minus G, we can come up with the valuation. We say the true value of a company based on their PBV, right, is ROE minus G divided by R minus G. So this gives you the intrinsic value, the intrinsic PE and the intrinsic PBV. Based on these equations, you can find out how much should this company be worth, that the intrinsic value of the company. Any questions? Okay. So we come to free cash flow based valuations. So, we have done dividend based valuations, dividend discount models, relative peer based valuations, relative valuation models. And now we come to another discounted valuation based on cash flows, what we call free cash flow models, right? Free cash flow models. So, in a dividend discount model, ultimately, forget about your equations. Ultimately, what happens? We make an assumption that as a shareholder, the price of the company is the present value of my future cash flows. As a shareholder, especially as a minority investor, right? Especially as a person who doesn't have a lot of say in the company, my cash flows are going to be my dividends. The dividends that this company is going to pay me over the next number of years to infinity, right? Obviously, we assume when we're doing these valuations that we hold this company. It's a hold to maturity investment. Just like for bonds, where we find the yield to maturity and the price if we held it until it matures, right? We find the value of a company as a hold to maturity investment. But a company goes on forever, unlike a bond. It is still the present value of its future cash flows, but now my future cash flows were dividends in my dividend discount model. So it was the present value of my dividends. Dividends are what are being paid out of the profit or cash flows that are being generated by the company. By the profit or cash flows that are being generated by the company. So at a company level itself, I can do this valuation. Without looking at the actual dividends that have been paid out, I can look at the potential dividends that can be paid out or the potential cash flows this company can generate from its earnings and profits, right? So, for example, without looking at the dividends that have been paid out, I can do a valuation for this company that looks at how much dividends can be paid out from this company. How much dividends can be paid out from this company. We call this concept free cash flows to equity. Free cash flows to equity holders, right? Free cash flows available to equity holders. So we forecast what are the free cash flows available to equity holders over a period of time. We use the same concept as dividend discount models. We might think that there is constant growth after a period of time, which is there forever. Same way here also we can think that there is constant growth after a period of time, which is there forever, right? But here now, what am I doing? I am not forecasting the actual dividends that are being paid out. I'm forecasting the potential dividends that can be paid out because I'm looking at the free cash flows that are available to equity holders, right? What do I mean by free cash flows? That's if I look at all the cash flows that my company is generating, how much cash flows are available and free to be paid out to shareholders. That's what I mean by free cash flows available to equity holders, right? Free cash flows to equity. So now I have a set of cash flows that look just like this. Only difference is this is actual dividends that are paid. Here, this is dividends that can be paid, right? Cash flows that are available to pay dividends. May or not pay the full dividend, but cash flows that are available to pay dividends. And the same way as before, I can discount these cash flows. We call it the present value of my free cash flows, free future cash flows to equity. Once I find the present value of my future cash flows to equity holders, this is the value. So what do I discount it by? I again discount it by my cost of equity. Cost of equity, right? Based on that, I can come up with how much is this company worth? What is the price I should pay for this company? This is what we call cash flows to equity holders, and then discount it by the cost of equity to come up with the price that we pay for this company. Okay. Same way, I can do another method to come up with the price to pay for the company. This we call free cash flows to the firm. Free cash flows to the firm. Right? Here, what we model is we try to find out free cash flows, free to be paid out to both debt and equity holders. What do you mean by the firm? The firm is both debt and equity holders. So if I have taken any loans, what are the cash flows that are available for me to pay out my loans? As well as if there is more cash flows available, I can pay my equity holders, my shareholders, right? So these are the free cash flows available to the firm. So I can model the free cash flows available to the firm. And just like I model the dividends, I will make certain assumptions and I can model the free cash flows available to the firm. I can, towards the end of life, meaning towards the end of the modeling period, forever, I can make an assumption about the growth rate of my free cash flows, right? The growth rate of my free cash flows. I can make that assumption. And based on all of this, I can come up with a price. The price that I come up with here is the present value of the free cash flows to the firm, future free cash flows to the firm, right? Here it is to equity holders. Here it is to both debt and equity holders. By discounting all of these cash flows, I can come up with the present value of free cash flows to the firm. Now, understand, this is not the value of equity, because inside this, my debt holders are also there. So this is actually the price of the whole firm, not the price of equity, unlike in dividend discount model or in the free cash flows to equity model. I straight away get the value of equity, right? But when I do the free cash flows to the firm model, the value that I get is to the equity holders plus debt holders. So because of this, I have to make an adjustment. I have to take out, this is today's value available to both debt holders and equity holders, right? today's value of my company available to both debt holders and equity holders. I want to know the value of my equity holders, the price that my equity holders are willing to pay. So because of this, I have to take out the value of my debt. We say we take out the market value of debt because we have discounted everything to today's terms. We simply have to deduct the market value of the debt of your company today. And what we are going to be remaining with again is the present value of your cash flows available to equity holders. Now we say present value of free cash flows to the firm. At what rate do we discount this set of cash flows? Because the free cash flows to equity, we discounted at my cost of equity. The free cash flows to equity, again here, although it's dividends, we discount it at my cost of equity, right? So at what rate do I discount my free cash flows to the firm? You're back, correct. You essentially have to discount this by our weighted average cost of capital. Weighted average cost of capital, meaning my required rate of return for both my debt holders and equity holders. For both my debt holders and equity holders, because I'm looking at the cash flows available to both my debt holders and equity holders. Therefore, I have to discount it by the rate required for both my debt holders and equity holders, which is a combination of my cost of debt and my cost of equity, which we call the WACC. Questions? Okay. Yeah. Yes, because it's a combination of, so as we go along the company, what we are saying is with that weighted average cost of capital, this is the target of how much equity holders as a proportion will be of the company and how much debt holders will be of the company. I mean, what is the weighted average cost of capital? It's the weight of the debt holders, the target weight of the debt holders into the cost of debt. Cost of debt is my required rate of return on debt. Of course, I have to use the tax shield plus the weight of equity into the cost of equity, right? So you're saying out of these debt and equity holders, I'm taking into the fact that the firm comprises of both debt and equity holders, and this cash flow can flow to both debt holders and equity holders. So therefore, when I'm looking at the discount rate, when I'm looking at how much return should the debt holders and equity holders get, right? How much return they should get over the future period, then I should be discounting it using my weighted average cost of capital, meaning just simply meaning how much debt holders are owed versus how much equity holders are owed. How much they want, debt holders want, sorry, versus how much equity holders want. So, I mean, it's a combined value that comes, but the combined value tells me This is how much my firm is worth today to both the debt holders and the equity holders, right? It is a blended value that comes. So then we have to, if we take out how much the debt holders are owed today, then what is left is what is owed to them or what can be paid to the equity holders, or what is attributable actually, what is attributable to the equity holders. Does that make sense? Is that the question you asked? Yeah. Conservative versus using just the cost of debt, but not as conservative as using the total cost of equity, because cost of equity will be higher than the cost of debt, right? I mean, for example, right now, PLR is at 9% odd. So that's the cost of debt, right? Versus that is the required rate by banks. That's where they're charging that 9% odd. So if I wanted to charge a different rate, that is the cost of debt for a debenture or government security or whatever. Versus cost of equity will be much higher. Cost of equity will take into account the volatility of the market. So therefore, cost of equity will be in the range of 15 to 20%. Versus cost of debt might be in the range of expansive range of like 9 to 12% ish, right? Right. For example, you just saw the commercial bank debenture that's coming out at 13 quarter. That's the cost of debt that anybody who's applying for commercial bank debenture issue is applying because they are okay with 13% returns, because their required rate of return is equal to or less than 13%, right? So that's the cost of debt for commercial bank, but their cost of equity is much higher. So more conservative it would be to discount it by the cost of equity, but that won't be right, because you're trying to come up with the value of the firm that belongs to both the debt holders and equity holders. Any other questions? Okay. So, excuse me. What do you mean by free cash flows? We said they are essentially cash flows, right? They are essentially cash flows. But these are the cash flows that are available to debt holders and equity holders, or cash flows that are available to equity holders. Now, when we look at a company, the company will have their profit and loss statements, they'll have their balance sheet, they'll have their cash flow statements, right? Just because you have your cash flow statement doesn't mean that the cash flows generated is your free cash flows. So we have to make some adjustments to figure out what are your free cash flows. Free cash flows are cash flows that are essentially the cash flows that can be used to pay out to equity holders and debt holders. Payout meaning any loans that you have taken or dividends, whatever, to debt holders and equity holders. This is what is available. So how do I come up with the free cash flows? Let's look at the free cash flows to the firm. Right. Free cash flows to the firm is what is available to both debt holders and equity holders. So you start with coming up with what are my cash flows? What are my cash flows? So what are my cash flows? EBIT minus 1 minus T is essentially my net income, correct? EBIT is my earnings before interest and tax. Earnings before interest and tax. And then if I deduct tax from it, this is essentially my net income. To this, I have to add back, because my net income or my profitability is not my cash flow. Inside my P&L, there are non-cash items. So I have to add back my depreciation. Right? I add it back. When I add it back, I see in my P&L how much cash I have made when I add back. So it's not just depreciation. I just use depreciation for ease here, but it's depreciation, amortization, and any non-cash item I have to add back. Right? any non-cash component, I have to add back. Once I add back all the non-cash items that are there in the P&L, I can see, okay, inside the P&L, this is the cash flows that I have generated, right? But in addition to the cash flows that are reflected from the P&L, there are other cash flows that are reflected inside the balance sheet. Like, for example, the fact that I've purchased inventory. Okay? I've made late payments, or I have payments pending, payables. Okay? Or I have payments pending to be paid to me, receivables. So cash that is due to me that hasn't come yet, cash that is due from me that hasn't gone yet, mean that if there is cash due from me that hasn't gone yet, I have better cash flows than I anticipate, right? If there is cash due to me that I haven't got yet, that means there is cash that is yet to come to me. So my cash balances are below what it should be. Inventory that I have paid for over the period. All of these have to be taken into account. So this is what we call increases in net working capital, right? Increases in net working capital is essentially the change in my current assets minus the change in my current liabilities. This is the increases in net working capital. Okay. As well as any capital expenditure that I want to spend on property, plant, equipment, right, buying machinery, buildings, whatever. After I spend on the company, what is left over, I can spend to pay interest, pay the loan capital, and to pay dividends. So my P&L tells me everything that I spent. Now I'm taking this. Do you see here? I'm taking this before interest. So I'm not considering interest, right? So before interest, what have I spent? What is the after-tax cost of that, right? Because I have to pay taxes on this component. And then I add back all the non-cash items. I will see within the P&L how much cash I have utilized, how much cash I have utilized without interest. Because interest belongs to the debt holders. That's something that I have to pay. That's what I'm trying to find out, how much money I have to be able to pay my debt holders, right? That's why I take EBIT, earnings before interest and tax. So from this, I deduct any CapEx requirements that I have. CapEx requirements is because to run this company, I need to buy this property, plant, machinery, equipment, whatever. So I deduct that CapEx, right? And then I also look at how much more money needs to come to me or go from me. The net increases in working capital. That's the change in current assets minus the change in current liabilities. Based on this, after I do all of that, look at the inventory, payables, receivables, add back the depreciation, all of this, then what is left is the money that is available to pay debt holders and equity holders. That is the equation, right? This equation will be given to you in your exams. There'll be a couple of equations like the equation below in red also will be given to you in your exams. Several equations will be given. You have to choose the one that fits you the most for your exam question based for free cash flows to the firm. But this equation is not something you need to remember, but intuitively understand what is this equation doing. It is calculating the cash available to pay back debt holders and equity holders. Okay. Once you have calculated the free cash flows to the firm and you have modeled these free cash flows to the firm. So how do we do that? When you do a discounted cash flow valuation, when you do a free cash flow valuation, we model, the analysts, they will model the P&L, the balance sheet, the cash flow statement, right? They'll model this in terms of they will come up with assumptions of how this company is going to perform. And based on that, based on those assumptions, they look at, okay, how is this company's revenue going to be over the next 5 years? How are they going to 5 years or 10 years, depending on the period that you're using? How is the volumes going to grow? How are the volumes going to grow? What are the exchange rates going to be? What are the interest rates going to be? How much, what is the like what are the components of cost of goods? Within that, how much is raw material? How is raw material impacted? Um, how much is labor costs? How are labor costs going to be impacted by inflation increases and all that? And we will forecast for each line item of the P&L, we'll forecast how each of these line items are going to change over the next 5 years or 10 years, right? And same way, we'll forecast the balance sheet. And based on this P&L and balance sheet, we'll come up with my forecasted numbers for free cash flows to the firm, which is what I showed you. You can come up with the free cash flows to the firm this year, next year, year after, right? So I will keep on, this is in year 1, 2, 3. I will keep on forecasting the P&L balance sheet over the next 5-10 years, and then come up with what are my free cash flows to the firm going to be over the next 5-10 years. And after the next 5-10 years, I will then assume these free cash flows are going to grow at some constant rate indefinitely. And based on this set of cash flows that I have forecasted, what's my next step? To look at the present value of these cash flows. So I'll discount these cash flows to today's terms. What is the discount rate that I'm going to use? Because these are cash flows to the firm, I will use the WACC. Because I have to use the discount rate that belongs to both debt holders and equity holders, I will use the WACC. Yeah. And I'll discount the cash flows. Yeah. Now, my job is not over though. Once I have discounted these cash flows to today, what I have is free cash flows to the firm. The present value of free cash flows to the firm. It's the firm. I don't want the firm's valuation. I want the value of the firm's equity. So to get the value of the firm's equity, what do? From this present value of the firm, I take out the component of existing debt. Once I take the component of existing debt out, what I'm left is what is available for equity holders. Any questions? Okay. So this is the free cash method. 1 means the free cash flows to firm method, right? Method 2 is free cash flows to equity. So just like before, we do the same valuation. I forecast my revenues, my cost of goods, therefore my GP, my administration expenses, operating expenses, all of these, I forecast the P&L. Upon forecasting the P&L, I come up with, and then I forecast the balance sheet, right? So I forecast the P&L, I forecast the balance sheet, and use the two to come up with my free cash flows to equity each year. So how do I come up with my free cash flows to equity? For my free cash flows to equity, I start with my free cash flows to the firm, right? I start with my free cash flows to the firm. Because free cash flows to the firm essentially tell me this is what is available to debt holders and equity holders. Once I know how much is available to debt holders and equity holders, each year I make an adjustment to just see how much is available to equity holders after paying the debt. Well, after paying the debt or getting new debt, right? So how do I do that? From free cash flows to the firm, I make 2 further adjustments. One is for the interest expenses I am paying that year, each year, and for any new debt that I'm taking each year. So find the free cash flows that are available to both equity holders and debt holders. from that deduct my interest expenses that I'm paying each year. But after tax interest expense, right? Because my interest expense is a tax shield, right? You might have heard that word. What does that mean? My interest, I am able to deduct taxes against my interest expense. Right? When I pay interest, I have a saving on taxes. So I take that into account, my after-tax interest expense. And any increases in debt. Why any increases in debt? Why do I add the increase in debt? Because I can take loans and pay dividends. There's nothing stopping me from taking loans and paying dividends, right? So I look at, if I want to see how much is available for equity holders to be paid out, I look at the net increase in debt. Based on this, I come up with my free cash flows to equity. And each of these free cash flows to equity, so these are now equity cash flows. Right? Equity cash flows. I forecast for the next 5-10 years, and then on a terminal growth rate forever. And then I come up with what is the free cash flows to equity by discounting this by the cost of equity. Cost of equity. And that's how I get the value of the firm's equity. Any questions? Shall I try a question? Try this one. So here the EBITDA has been given earnings before interest, tax, depreciation, and amortization. Right. So you use the EBITDA equation versus the EBIT equation. Okay.
Ayo.
Mm. Right. So I just put the equation here just for your convenience. You're using, okay, so there's a question that says to get the interest expense, do you want to calculate backwards? You don't need the interest expense, right? Here you're trying to figure out free cash flows to the firm, right? And then value the firm's equity. So based on the free cash flows to the firm. So therefore, you don't need the interest expense. EBITDA is interest before, earnings before interest, tax, depreciation, and amortization. That's okay. Let me just check. Sorry, 28. I'm trying to calculate the answer. 1 second. Or somebody else has to come up with the answer to see. So Nimasha, try to send it to me, direct message, but the answer is not correct. 28 answer is not correct. I think what you all are missing out on is that you have to. So this is also one thing is the answer that you all are giving me is the free cash flows to the firm, right? But what free cash flows to the firm is relevant? What free cash flows to the firm is relevant? And then you have to look at what is the value of the firm and what is the value of equity. So free cash flows to the firm this year is what you have given me. Year zero. So year zero free cash flows to the firm is correct for both 28. But now the question is, what is the value of the firm's equity? Value. Or the price. Rashmi, no, there is something wrong here. And there is not enough information for you to find the free cash flows to equity. So what you have to do is you have to do the valuation, the price, right? The value of the firm's equity means what is the price? Not the free cash flow. What is the price? Just check your answer again. So this sum, if you just look at it, is giving you all this information. And at the end, it says, or at the beginning also it says, EBITDA was 2 million and it is expected to grow. Sorry. It is expected to grow at this rate per year forever. So is dividends. So is dividends, right? It's indefinitely expected to grow. You have to come up with the price of the company. To come up with the price, first you have to find what is the cash flow of the company and what for the information available, the only thing that you can find is free cash flows to the firm, not free cash flows to equity. And based on this cash flow and based on the fact that these cash flows are expected to grow forever, you have to find the value of the company today.
Madam,
Yes, go ahead.
so will there be an increase in net working capital since the company's EBITDA will grow by 5%?
Yes, there will be. But do you see that that increase is also the same rate of increase as EBITDA, right? Because it's directly linked to the EBITDA growth. No? So the rate of increase of the net working capital is also the same rate. And even the depreciation increase is also the same rate because it says it's expected to grow at the same rate as EBITDA. So everything is growing at the same rate. So let's try that. So you have EBITDA in year 0, right? In year 0, EBITDA is 2. EBITDA is 2 and expected to grow by 5%. So when it grows by 5%, it will grow from 2 to 2.1. Okay? So that's EBITDA. I need EBITDA into 1 minus tax. Tax rate is 35%. So EBITDA into 1 minus tax comes to 1.365. Okay. Why can you tell me? Am I looking at year 1 instead of year 0? Why? You can look at year 0. Why am I looking at year 1 instead of year 0? If I did this for year 1, it will be 1.3. Okay. To make this happen, the firm will have to invest an amount equal to 20% of pre-tax cash flows, that is EBITDA, each year as capex. So how much is capex? Capex is 20% of EBITDA. So 20% of 2. Right? That's CapEx. So net working capital is not provided here, right? If it was provided, you'll have to take that into account, but it's not provided here. The only other detail that's provided here is, so now I have EBITDA into 1 minus tax. I have CapEx. I need depreciation into tax. So the depreciation is 0.2, 200,000. And depreciation is expected to grow at the same rate. So 200,000 becomes 210,000, right? And depreciation into tax becomes 0.07. Okay? 0.21 into 0.35 becomes 0.0735. Right. So from this now, I can come up with what is my free cash flow to the firm. Sorry. Oh, sorry about this one. Right. I'm right at the bottom. That's why it's touching all the consoles. So free cash flows to the firm. Free cash flows to the firm is essentially EBITDA into 1 minus T minus capex minus depreciation. So from that, I saw you all got 970,000, right? If we did year 1, 1018, 500, okay? Just look at what is the growth from year 1 to year 2. This you know is 5% growth. This you know is 5% growth. This you know is 5% growth. How much is this growth? That growth is also 5%, correct? Right? So all of these growth rates are 5%. So whether you found the 970 and increased it by 5%, or whether you did it in between and increased and found the final answer, it doesn't matter. You still get 1.0185. Now I know the free cash flows to the firm in year 1 and in year 0. I want to, and it says these will keep on doing this and keep on increasing like this indefinitely forever, right? So therefore, you understand that free cash flow will also keep on increasing by 5% forever. Okay. Free cash flow will also keep on increasing by 5% forever. Then, now, I know the free cash flow in year 0, and I know the free cash flow in year 1. I want to find the value of my company in year 0. This is year 0. This is year 1, 2, and so on. What's the next step I should do? What's the next step I should do? What does this look like?
Constant growth.
Constant growth. It is a constant growth model. Exactly. And where does that constant growth start? From year 0 onwards, right? From year 0 onwards, it's starting and it's growing at a constant rate forever. But what is growing? My free cash flows are growing at a constant rate forever. Okay. Free cash flows are growing at a constant rate forever. So to find the value of my company, what is the equation I should use? The value of my company today should equal, what is the equation for a constant growth model? Instead of D1, I will use what is the equation for a constant growth model? Can't remember. Yeah. D1 divided by R minus G. But now that's correct. For a constant growth dividend model. Now we have a constant growth free cash flow model. So what is the equation? How should the equation change? Correct. The equation should now become my free cash flow to the firm next year. Because in the dividend discount model, what is the value? Dividends next year divided by R minus G, right? So my constant growth model, instead of dividends, now has free cash flows to the firm next year divided by R minus G. But here, what is the R that you use? What is the R that you use? Yes, sorry, I just saw it. Correct. WACC. The R that you use is WACC. So instead of R, you can say free cash flows to the firm. Therefore, it should be your WACC. WACC minus G. So from that, you can calculate what is the value of your company. What are the things that are confusing you? Is it just that you're not participating today, or you're not confused, not quite understanding the dynamics? What's confusing? What are the things that are confusing? We can talk it out. No. Sure, okay. So one thing to understand is, see, there is you have to see how you're going to switch between these models, because the constant growth, they are just mathematical equations, right? It's what you insert into that equation that makes it the model. In a dividend discount model, in a dividend discount growth, constant growth model, it's dividends divided by R minus G. And what is R in a dividend discount model? It's the cost of equity, because you're looking at dividends and shareholders. So it is the return that is required by shareholders. In a free cash flow model, if it is constant growth, it is still the next cash flow divided by R minus G. But here, what is the next cash flow? Your free cash flow to the firm, right? It could be free cash flows to equity if you're looking at a constant growth model for equity holders. But here, what we have found is free cash flows to the firm, right? And if I'm using free cash flows to the firm, the R that I have to use is the WACC. Okay, good. To calculate the WACC, we need the cost of debt also. But here, another word for WACC, this is the weighted average cost of capital. So what has been given to you is the WACC. You don't have to do any further calculations. The cost of capital has been given to you, right? So the cost of capital, what is your capital? It's debt and equity. So the amalgamation of both debt and equity is 12%. Really, does that make sense? I think still, is it still a question? So remember, now when I look at this model, all I'm looking at is a set of cash flows. But now what are my cash flows? Not dividends. They're free cash flows. And what free cash flows? Because there are two types of free cash flows. There are free cash flows to the firm. I know what my free cash flows to the firm are going to be, and this free cash flow is going to keep on growing at a rate of 5% forever. So because of this, I can use this equation to calculate the value of the company. Free cash flows to the firm divided by WACC minus G. Minus G. So free cash flow to the firm next year is equals to 1.0185 divided by WACC of 0.12 minus growth rate of 0.05. So thank you, 28, Nimasha. Correct. I'm told it comes to 14.55 million. So this company is worth 14.55 million. Is that the answer? Is that the answer? 28, correct. It is not the answer, right? Because when I say this company is worth 14.55 million, it's actually, what is the company? It is the value today for both debt and equity holders. Nimasha, correct, right? Because that's what we use. We use the firm's cash flows, discounted it by the firm's WACC, right? So the value that we got is the value of both the debt and equity holders. So to come up with the value of equity holders, I have to reduce the market value of debt. How much is the market value of debt? 4 million. 4 million. Give me 10.5. So the share value of this company is worth 10.55 million. If I divide this by the number of shares, which is not given here, I will find the per share price of this company. Okay, any questions? This is an example of free cash flows to the firm, right? The next, yeah, go ahead. There's a question. Hera?
Is it 4 million you deducted?
Sorry, I can hear you speaking, but very faintly. I can't hear you.
What is that 4 million you deducted from 14.5?
What is the
4 million you deducted?
4 million?
Yeah.
The firm has debt of 4 million inside it, right? So remember the equation, the value of equity, when we use the free cash flows to the firm model, is the present value of your free cash flows minus the market value of debt, right? So this is the value of the free cash flows to the firm minus the market value of debt comes to 10.55. Is that okay?
Yeah.
Okay. So it's the first question. We'll do a couple more questions. We'll anyway for next week. Try this question, right? Now, this question, when you are trying it, you have been given an income statement and a balance sheet. Right? This is the free cash flow to equity example. So you have to calculate the free cash flow to equity and calculate the equity value of the firm. Just remember, when you're looking at, now remember the equation, you have to find free cash flow to equity. Free cash flow to equity means free cash flow to the firm minus these further additional things, right? So free cash flow to the firm, you have to get your EBIT into 1 minus tax, or you start from net income, right? Excuse me. And then you have to look at your increases in net working capital and your capex. So here you have your net income, right? You have all of these, and then you have your current assets, current liabilities. That's your working capital. Change in current assets minus change in current liabilities, right? Change in current assets minus change in current liabilities. That's your net working capital. And for your for your capex is your change in your property, plant and equipment, changing property, plant and equipment, or your PP&E plus your depreciation, right? That equation is given. Why is that? We'll talk about that next. Try it, right? That equation is given. Just try and see, and we'll come to it and we'll talk about it next week. So I know it's confusing, so we'll do a couple more sums before we move on to the next section. I thought this section was nearly over and we were a little ahead, but I think this is a little bit more confusing for you all. So we'll do a couple more sums before we move on to the next section next week. Yeah. So we stop there.
Thank you, madam.
Thank you very much.
Thank you, madam.
Thank you. Thanks. Sorry, thank you. There is a question that 28, in this example, debt is 0. It means no interest. That's correct. In this example, there is no interest. Correct.